you have a tangled web of accounts, maybe retirement accounts that have been left over from old employers that you haven't looked at in a while, they send quarterly statements, but who knows what's going on there, and maybe a growing web of investment accounts that are scattered across different financial institutions like Vanguard, Fidelity, Schwab. As you progress through your career, not paying attention isn't such a big deal because you have your head down, you're focused on making a living, paying the bills, and taking care of a family. But as you approach retirement and you turn your eyes towards the future a little bit more, it becomes much more important to focus on the complexities of those accounts and where they live, and more specifically, how they are taxed or will be taxed in the future. It's time to start paying attention to the web of assets that you have. So before we continue, hi, I'm Brendan Dooley, a retirement income planner and your host of the Spooky Retirement Advice video series. Today, I'm going to be talking to you about the web of assets and how important it is to start figuring out how they will play into managing your lifetime tax bill and making sure that you don't overpay your taxes. So as a brief refresher, you're going to have accounts that have one kind of taxation out of three possibilities. Your pre-tax accounts will have taxable dollars coming out. Every penny that's in there, if it's a traditional IRA or a traditional 401k, traditional 403b, as long as you didn't make after-tax contributions, every dollar that comes out of that will be taxable to you, unless you have so few dollars coming out that you don't exceed the amount of your standard deductions. So you can just safely assume that for most of you out there, every dollar you take out will be taxable. Then you have your tax-free accounts. These are more commonly known as Roth accounts. Our distributions, so long as you meet the qualifications, will come out tax-free. That's both the principal that you put in and, of course, the earnings. Finally, you have the brokerage accounts, or sometimes confusingly deemed taxable accounts. Now, you may have noticed that the pre-tax or traditional accounts were also taxable, but the difference is that taxable brokerage accounts are taxable annually, whether you take money out or not. So if there are dividends, interest, capital gains that you're earning along the way with the investments that are inside that account, you'll have to pay tax on those annually. Whereas a pre-tax account, it doesn't matter how much you make in interest, dividends, capital gains, so long as the money is still inside of that pre-tax bubble, you're not going to pay any taxes annually on that. If you take money out, take distributions, different story. So that's the landscape we need to start understanding our accounts in. How will they be taxed in the future if you haven't had to pay any tax on any of that stuff yet? So you can think of the pre-tax accounts certainly as a partnership that you have built with the IRS. The name of the game, if you're looking to pad your retirement and your retirement income that you can enjoy, is to manage your lifetime tax bill. How can you keep more of what you have already saved, amassed, built, and will continue to save before you retire? So this is where some strategy can be really helpful. I'm going to walk you through some software that I utilize with clients to demonstrate the different withdrawal strategies that might make sense given a specific set of circumstances that can be broadly applied to a lot of people as they're approaching retirement. It can help you see there's a lot to be gained by being strategic with the assets, even if so far your approach has just been to put the money aside and stay out of the way. So I have Mike and Sarah that I want to introduce you to as some hypothetical clients. They are clients that are getting ready to retire in the next 5 years. And what's important about that is they have some time, they have a runway, so to speak, where we can actually make some decisions that might make their retirement a lot more lucrative and just shore up the sustainability of their income that they'll eventually enjoy. So I have a smattering of just hypothetical accounts and balances in here of the traditional pre-tax type. So traditional IRA in Mike's name, traditional 401k in Sarah's name, and then a joint taxable or brokerage account that's about $800,000. There are some bank accounts in here and the value of their primary residence. On top of that, I have some hypothetical income amounts in here from a rental property. Sarah has a pension, and finally their salaries until they're done working. From the liability side of the balance sheet, they'll still have a little bit of mortgage left. They are making some contributions to savings accounts of different kinds before they retire. So we'll keep those up until their retirement dates. You can see here that Mike, currently 62, and Sarah, 61, they're both planning to retire in the next 5 years. So finally, we have some expenses that I'll go through, and I can't overemphasize the importance of clarifying your expenses. This is the crucial ingredient to nailing your retirement. A very clear-eyed understanding of what do I spend, and not only what do I spend, but what do I want to spend. So you may already be familiar with the different phases of retirement, and this is why a static approach, say the 4% rule, is so dangerous. Your expenses are going to change as your life unfolds, for one, but also the evolution of your health. You're probably in the best shape you're going to be in for the rest of your life. And I don't mean that as a slight against any improvements that you're making in your fitness, your health, diet, whatever. All I'm saying is with the addition of more years and more trips around the sun, our health tends to decline. So you go through phases in retirement. The first one will be the go-go years, where in those go-go years, you are probably out spending money, you're enjoying yourselves, you're doing all the things that you couldn't do while you were working or raising a family. And that's understandable. So you would have this kind of pent-up demand for travel, fun, going out to eat, going to shows, whatever you do that's fun and fulfilling to you that you have otherwise had to delay. So with that said, we can't keep that up forever because eventually our health and mobility catch up with us. So then we enter the years, which is the next phase of spending, where we might still be able to do some of that, but it might be on a smaller scale or just not as frequently. So our discretionary spending tends to drop a little bit. Then finally, in the no-go years, health is really starting to play a bigger role in our finances, and discretionary spending that we were doing might have come down, but the share of our expenses that are health related may have increased or surpassed what we were spending previously on just fun money. Getting your expenses correct when we're doing this kind of planning is crucial. I can help you. Competent planners can help you figure out what are your actual expenses today, since most people don't know. And finally, what will they be certainly during the go-go years of retirement? We have some expenses baked in here. Let's take a look at how things look for them financially. Mike and Sarah are in pretty good shape. They have a couple $1,000,000 to their name. And before we go any further, again, my name is Brendan Dooley. I'm a retirement income planner. I help people take their decades of savings and turn it into a great retirement paycheck that's sustainable for the rest of their lives so that they don't run out of money and they can actually enjoy themselves. So this is really meant to be simple to understand, because if you have $2.1 million today, that means based on their numbers, they could enjoy an all-in monthly paycheck net of taxes that is about $11,200. Now, if the portfolio grows to almost 2.4 million, we can give them a little bump. Their paycheck goes up, they get a raise. If the portfolio drops to about 1.4 million, for round numbers, we're going to have to give them a temporary pay cut to allow the portfolio a little bit of time to recover. Now, what I want to show you beyond the capabilities of this guardrails approach to retirement income is the withdrawal strategy that I think gets overlooked, or the importance of it gets overlooked, because people don't know that there are this many options. You have the choice of taking out a little bit from each account to fund your bills. The conventional advice would be to take the taxable brokerage account, exhaust them, then you move on to the tax deferred account, then you move into the tax-free account. So that could be the best situation for you, but I want to introduce you to the capability of a planner and a software together working to figure out what is the best outcome for you, because your withdrawal strategy is going to be unique to the assets you have and how they're positioned from a tax perspective. So I can run for you what happens if you were to take, for example, all the tax deferred account assets out first, exhaust them, then you move on to the taxable, then you move into the tax-free or Roth accounts. So if we were to rank these from best to worst, that would actually be the ideal situation for these folks, where if they exhaust all of the tax deferred accounts and then move on to the taxable and finally move through the Roth, their total net legacy will be just under $5.7 million. So that's going to mean, while they're enjoying the paycheck I showed you before, they're going to die with that much money left over. We can scroll down and see that if we were to start with the tax-free assets, go into the taxable assets, and then finally exhaust the tax-deferred assets, there's a big difference in outcomes. So $4.965 million compared to $5.675 million. So that is a big swing, several $100,000, and that would be money that you could gift to people or causes you care about today. We could craft a gifting strategy that would help you fulfill certain legacy goals in advance, because when you're dead, you won't be able to enjoy the look on the face of your son or daughter or grandkids when you gave them money for college or for their kids' college fund. The same thing with a charity. If you wanted to support the charity, we could find a reduced amount that you would give today that you would have otherwise given to them when you died, so that you can actually see the benefit of your charitable intention. So knowing that you're going to die rich would help, I think, accelerate some of that gifting that you might like to do, but just haven't seen that it's possible yet, or that it was in your best interest. Going back to the conventional advice of taking out all of the taxable assets first, and you move into the tax-free, you can see that this actually would be pretty terrible advice. If they were to employ that, their net legacy would again be this $4.965 million. And they would leave almost $700,000 on the table in the form of what is essentially tax savings from just being strategic about the way that they unwound this tangled web of assets that is pretty typical, where they have big chunks of money in pre-tax accounts that haven't been taxed yet because they're from when they were making contributions as an employee to a retirement account that was sponsored by an employer. And those investments have grown, and so too will the eventual tax bill that gets associated with the distribution of those assets. So I hope, if nothing else, this has showed you that the conventional advice might be a good fit for you. It might also be a really costly mistake to the tune of several $100,000. In this case, again, it was almost $700,000 of difference. Now, we could also explore the legacy goal that you may or may not have and use that knowledge and then experiment to perhaps increase the amount of money that you can take and enjoy on a monthly basis. If you were sitting there saying, I don't want to die with, my gosh, almost $5 million or $6 million worth of assets, I would much rather spend more money today. Great news, we can use the software to figure out what a more robust monthly paycheck would be, so that you don't die with so much money left over. We'll make sure that it's sustainable and not going to cause you to run out of money, but at the same time, not going to create this enormous legacy that really will amount to wealth that you didn't get to enjoy. And it's fine if you want to leave money behind to somebody else, or people, or an organization, a cause, a charity, but you should do that with the understanding of how much it's going to be, and certainly what is possible instead if you would like to balance that higher income goal that you might have for yourself with the eventual amount that you'll give when you die. My name again is Brendan Dooley. I'm a retirement income planner. I help people find that delicate balance between a great retirement and not dying with so much money left over that they are going to have some regrets about underspending along the way. If this video was helpful, I hope you'll like it. I hope you subscribe to the channel. Please leave a comment below to let me know if there's anything that you'd like to explore more of, or that I can clear up for you in a future video. In the video's description, there will be a link to the retirement income style assessment that will help us determine what your retirement income paycheck would look like and make some decisions about how to unwind the tangled web of assets for you. Thanks so much, and see you in the next video.